Thank you, Paul. Can you hear me?
Yes, we can hear you.
Good.
Perfect.
All right. Thank you, Paul, for the opportunity to update the group on the status of efforts to clarify the taxation of digital assets. To date, most legislative and regulatory attention has been focused on stablecoins, market structure, and illicit finance. But in recent months, crypto tax has finally caught the attention of lawmakers. The House Ways and Means and Senate Finance Committees held hearings on the topic in the past few months, and there are legislative proposals floating around that have pretty broad bipartisan support. Now that the government is reopened, I do think that we could see a crypto tax bill in this session of Congress. Today, however, I wanted to report on a couple of very recent developments that may be of interest to this group. First, the Office of Information and Regulatory Affairs, OIRA, posted a notice last Friday announcing that proposed rules for the implementation of CARF, which is the Crypto Asset Reporting Framework, into the broker reporting regulations under Section 6045 have been sent to the White House for review. So that means this has been an ongoing regulatory project that's been out there for some time, but it has now reached the state of development where it's now at the White House for review. So I think we're pretty close on CARF implementation. Just by way of background, for those who aren't familiar with the broker reporting rules or CARF, thought I'd go through that for a couple of minutes. You may recall that regulations were finalized in July of 2024, so about a year and a half ago, providing for information reporting by custodial brokers of digital assets. And what those rules do is require brokers to report to taxpayers and the IRS on the gross proceeds from dispositions of digital assets starting January 1st of 2026. So it's coming up. We'll start to see our first 1099 DAs from brokers like Coinbase and Kraken and the like starting next year. Regulations were also finalized in December 2024 that would have required similar reporting for DeFi transactions, but those regulations were repealed by Congress after President Trump took office. So right now, these rules apply to custodial brokers. So what is CARF, and what does it mean to integrate CARF into those existing broker reporting rules? Well, CARF is a regime for the exchange of information on digital asset transactions between tax authorities. This was formulated by the OECD in 2022. And so to point out the obvious, because it's an OECD document, it is not law. It is essentially a draft law, and needs to be adopted into the laws of member states in order to become law in those countries. CARF is similar in purpose to the FATCA regime that was created to exchange information between tax authorities on traditional financial transactions, and that's been out there for years. So to some extent, this is not new. It's sort of extending the concept now to digital assets. So far, more than 60 countries have committed to implement CARF in their national law. The EU has already done so. The US is committed to do so by 2028. And the Section 6045 custodial broker regulations acknowledged that the US rules would need adjustment in order to implement CARF, and at the same time reaffirmed the 2028 timetable. Finally, the White House Crypto Task Force on in its digital assets report from July recommended that Treasury and the IRS should move forward with proposed regulations to implement CARF, but that, quote, take stakeholder concerns into account and minimize burdens on brokers. So sort of signaling a cautious and measured approach. The report also noted that any such proposed regulations, quote, should not impose any new reporting requirements on DeFi transactions. And as I noted a minute ago, the DeFi regulations were repealed. So since there aren't any reporting requirements on DeFi transactions right now, saying that there should not be any new reporting requirements on DeFi transactions might or might not be a signal that the administration does not intend for CARF to apply to DeFi, at least the U.S. implementation of it. So what does this mean for our digital asset broker reporting regime? Well, CARF doesn't replace the U.S. rules. It would complement the existing rules. And the reason is the two regimes really have different purposes and scope. Section 6045 is intended to provide information to both the taxpayer and the IRS. So the taxpayer has the information they need to file their return on potential capital gains and losses, and the IRS has information that helps with identifying risks of compliance. So it's intended to facilitate our existing voluntary compliance regime. But it provides, to that end, provides information on specific transactions. So the taxpayer knows how much gain they had on a particular transaction. CARF, on the other hand, is really only intended to provide tax authorities with information, and specifically to allow them to assess non-compliance risks. And to that end, it only provides aggregate data on each taxpayer, not transaction by transaction. The current Section 6045 custodial broker regs have reserved sort of a placeholder in the regulations relating to the application of the U.S. rules to non-U.S. brokers. The proposed regulations had extensive rules under which the U.S. broker reporting rules would have applied to various categories of non-U.S. brokers. But the reason it was reserved in the final regs from July of 2024 was to leave room for the implementation of CARF. In the absence of CARF, if CARF isn't implemented, then the Section 6045 rules likely would be amended to apply to many non-U.S. brokers, requiring them to file reports directly with the IRS. If CARF is implemented in the U.S., the way this would work is the IRS would collect information from U.S. brokers only and share aggregate information about non-U.S. persons that do business with those U.S. brokers with the tax authorities of the country of their residence. And foreign tax authorities would collect information from brokers in their country and share that aggregate information about U.S. persons with the U.S. So it's an exchange of information. So some final notes on CARF. It's only effective between countries that have adopted CARF into their national law. So it's a mutual exchange regime. It does require the implementation. In order for a country to come on board, they have to implement a variety of data privacy and security safeguards for the safeguarding taxpayer information. And CARF, by its terms, but the CARF regime does apply to some forms of DeFi, but the current administration seems, by my read, disinclined to impose information reporting obligations on DeFi. So perhaps the U.S. flavor of this would not go so far. The other item I wanted to just make folks aware of, many of you probably are already aware of this, but is some developments on staking, specifically staking by exchange-traded products, exchange-traded funds. Staking and mining, I think many of you know, presents a variety of novel tax issues. For example, the most contentious of those is the timing of income for tax purposes. Is staking income services income that's taxable when it's received, or is it income from self-created property that's taxed when the property is sold? A less well-known issue, but one of critical importance to the many crypto ETFs that launched this year, is whether the ETF will still qualify as an investment trust that is a grantor trust if it stakes the crypto assets that it holds. This is very important to the tax treatment of these funds and the impact it has on their shareholders, on their stakeholders. The IRS issued a revenue procedure 2025-31 on November 10th that provides some very helpful guidance on this issue, indicating that an investment trust can be treated as a trust for this purpose, but that the sort of existing law on this is that the trust must have no power. There must be no power under the trust agreement to vary the investments of the certificate holders. And that's sort of the question, is whether staking somehow is an activity that would trip over that. The revenue procedure provides a safe harbor under which an investment trust that stakes digital assets can qualify as a trust if certain requirements are met. And amongst those that I think people will have to sort of debate around a little bit in terms of whether they present an issue for the way existing crypto ETFs are operating, is that the assets have to be staked through a staking provider unrelated to the fund and its sponsor. The trust sponsor and custodian of the assets cannot control, and query what control means in this context, the staking provider. Assets have to be staked at all times, with some limited exceptions related to liquidity. Assets have to be indemnified against slashing. The funds can only own one type of asset, so mixed asset ETFs would be a problem here. And staking rewards must be distributed at least quarterly. Unanswered questions here is whether staking income of non-U.S. investors is effectively connected income with effectively connected with the U.S. trade or business, whether staking income is U.S. source income subject to 30% withholding tax, and whether staking income is unrelated business taxable income for tax-exempt investors. So more to come on this, but certainly a very positive development for the industry. Back to you, Paul.
This one, Taylor, thank you so much.